Hi, I'm Monk and this is the Monk Way. Let's analyze IQ, the Netflix of China, before I invest in this company. This will be a more detailed analysis. We'll take a look at their numbers, their company as a whole, and compare them to Netflix. This should tell us if they'll spike up in the future. Subscribe and hit that bell for more stock analysis. I make them every day on great stocks to watch, and leave a like if this video taught you something new. IQ just had their IPO on March 28, so let's look at their numbers. They're up 79% in the past 3 months, a very nice growth since their IPO. This is a non-profitable company, so let's use Netflix as a comparison. They have a market cap of 23 billion, compared to Netflix at 170 billion, 7 times smaller. No PE ratio because they're losing money. Netflix has a high PE of 262. A negative forward PE ratio, so they're expected to lose money in the near future. Netflix has a better forward PE of 85. The price to sales is the important number, comparing their stock price to their revenue. IQ is 7.88, pretty high compared to the average of 3, but Netflix is 13.34. If we're pricing these two companies the same way, there's a 70% upside to IQ. They have a price-to-book ratio of 14.43, compared to Netflix at 42, and a debt-to-equity ratio of 0.07, low debts. Netflix has high debt of 1.62. This is a very low-value stock from their numbers, with an upside comparing just revenue. Let's continue by digging deeper into their numbers. They started recording income in 2015, so we have 3 years of data. Revenue saw a huge spike from 846 million to 2.57 billion. In 2015 they grew almost 100% in revenue, and in 2016, they went up 52% in a year. Extremely high growth rate. Let's compare to Netflix's past 5 years of growth. We can see here, there was an average of 24% a year in revenue growth. Good growth but not as high as IQ. This is to be expected because IQ is a newer company. They started in 2010 while Netflix was founded in 1997. Now we'll compare their gross income. This is money they get to keep after costs of goods, such as their digital content. It looks like it costs IQ more than they make to stream their content. We saw a loss of 115 million in 2015, but a lower loss of 1.22 million in 2017. Netflix keeps a good chunk of their revenue. In 2017 they kept 4.03 billion out of 11.69 billion, or 34%. After paying employees, reinvestments, and other fees, IQ has a net loss at the end of the year of 552 million. Netflix had profits of 558.93 million in 2017. Let's take a closer look at their most recent quarters, telling us their recent earnings. They made about 700 million for each 3-month period, with March 2018 having an increase of 57% year-over-year. We can see they started keeping more in the gross income, with December having 42 million. But we still have other fees, so the net income at the bottom is still in the red at 62 million. I read their recent earnings statement and here is a simple summary. They claim 520 million members on their platform, with 60 million being paid. Total revenue up until March was 777 million, as we saw previously, a 57% increase year-over-year. Their premium membership generated 334 million, a 67% increase from last year. Advertising revenue from free members was 336.5 million, a 52% increase. Content revenue was 42.5 million, a 44% increase. This is money they get licensing their original content to other partners. Other revenue was 64.6 million, 51% increase. This is money from all other sources of income. In total it was 777 million, but cost of revenue was 773 million, a 44% increase. This came mostly from cost of licensing content, which represented 617 million of all costs, compared to Netflix, which put 8 billion on new content this year. 112 million went to administrative expenses, including promotions and management. They reinvested 61.7 million into research and development. This is any new improvements to their system. They had a loss of 63 million in that quarter. For the next quarter, they expect 950 million of revenue, a 45% increase from last year. Basically, revenue is up very nicely at a 57% increase. Let's do a quick comparison to Netflix. Netflix had 3.7 billion in revenue, a 43% increase year-over-year. 4.76 times as much revenue as IQ. Their market cap is 170 billion, 7.4 times as much as IQ. If IQ was the exact same company as Netflix, IQ's market cap would have to be 35 billion to be priced the same way, making their price $49. This is a 52% upside from the current price of 32.30. But the market won't price these two the same way. Let's look at some differences. Netflix has 125 million paid members, compared to IQ at 60 million. Netflix charges about $10 per account, while IQ only costs $3 a month for mobile and $7 for TV. But IQ does make money from its 360 million free users, about the same amount as paid users. But even combining paid and free users, IQ is only making 777 million, compared to 3.7 billion Netflix is making. This means even if IQ's free and premium users doubled, they would only make 1.3 billion in revenue compared to Netflix at 3.7 billion. Each paid user in IQ is making a lot less than Netflix accounts. Each Netflix paid user user is giving Netflix $10 a month. 125 million times $10 is 1.25 billion a month, or 3.75 billion per quarter, which contains 3 months. This checks out perfectly with their latest report of 3.7 billion. Each paid IQ user seems to only generate $1.85 a month. Their income statement says a revenue of $334 million in the past quarter from premium users. Dividing that by 3 for the per month revenue, we get $111.33 million. Since they have 60 million paid users, dividing that by 60 million, we get $1.86 per user. This means each premium user is paying 5 times less than Netflix. Their 360 million free members generated about the same revenue. IQ would need 5 times as many members to make the exact revenue as Netflix, meaning 300 million paid users, and 1.8 billion free users. This is very unlikely even in the future. It's possible that users are paying a huge discount right now due to their new member offers. These users might pay more once their trial period is over. Many articles mention IQ having half the number of subscribers as Netflix, but they don't mention each user pays a lot less. Not only that, but Netflix has much more gross income. 1.5 billion from 3.7 billion of revenue is gross income, compared to IQ having only 4.57 million out of 767 million. That's 40% revenue kept compared to 0.6% revenue kept. And IQ is not profitable, a $62 million loss compared to 290 million profit on Netflix. IQ might be putting a lot of money into new content, giving them less gross income, but this really lowers their numbers. And with a lower revenue from each premium and free user, they'll have to have a lot more users for the same revenue. If they had the same number of subscribers as Netflix, they would not be worth the same amount as Netflix because of this. Let's look at their balance sheet. Not much cash of 142 million, total current assets being 960 million, 3.64 billion of total assets, current liabilities being a huge 2.14 billion, meaning they can't afford to pay off their money owed with only 960 million in current assets. This is not a good sign because this is money that has to be paid in under a year. Good news is they only have 107 million of debt, with enough cash to pay it off, with 1.36 billion of equity, a good debt to equity ratio. IQ has low numbers, making them high risk. But if they continue increasing revenue on this high pace, their stock will likely follow. In order to be priced like Netflix, they have to increase profits. This might not happen until years down the line since they're spending a lot on new content. I think this is a valid strategy since Amazon and Netflix also did this mass expansion at the cost of profits, both paying off nicely. Next, we'll look at their platform and news. Let's check out their site on the computer. The design is not as clean as Netflix with more words, but similar thumbnail pattern. You click a video that looks interesting to watch. Usually an advertisement plays for free users, paid users won't have these. The platform looks a lot like YouTube and it contains user videos as well. So not only is this the Netflix of China, but it has YouTube elements. A good amount of videos seem to be for paid members. Let's click on something familiar in the United States section. Ironically, I chose Ghost in the Shell. It played, but seems to only allow a few minutes for free members. Some videos are free with ads, but a lot are paid only with previews. Here we have Better Call Saul, a personal favorite. They partnered with Netflix for some of their content, so it's nice to see this here. After a 60-second advertisement, it played fine. I was surprised since this is something I would watch. I considered using this site to finish this series since my ex kicked me off her Netflix. Ad block also seems to not work. I assume they host all their advertisements which would get past ad block. Better Call Saul loaded perfectly even on a non-Chinese connection. And I like the full browser option. It's a nice platform, a little more cluttered but very easy to use once you're used to it. It looks like a combination of Netflix and YouTube. IQ was spun off of the Google of China called Baidu. They launched in April of 2010, only 8 years ago. 6 billion hours are spent on there every month, with over 500 million users. They are the most popular video platform in China. The CEO is called Gong Yu, so you know he gong make you money. Moving on. Just like Netflix, IQ creates their own series. They had 5 of the top 10 internet variety shows and 6 of the top 10 internet dramas in China. IQ uses artificial intelligence from Baidu to determine new content. Understanding what users want to see and how much to spend on a new series or movie. This is something Netflix also uses with their content and algorithm. They are also the first company to have DRM, meaning all content is secure on their service. China is known for piracy, so this is a good sign. Studios would feel safer having their content on IQ. China's video revenue is expected to increase in the coming years, much more than Americans. IQ is expected to grow past 200 million paying subscribers if it increases at the expected rate. Even if they're not making as much as Netflix, that's still more than double the current revenue. This is thanks to huge smartphone growth in China. In 2017, almost 600 million people got smartphones versus only 40 million in America. This means future growth will be much faster than America's online video revenue. A strong company has strong partners. IQ partnered with another stock I analyzed recently called JD.com. Any member who signs up for a premium service received the same service on the other platform, meaning premium JD members get premium IQ accounts for free, and vice versa. This boosted IQ paid members by 1 million in the first week, and it should keep increasing. It's also partnering with other Chinese giants in Tencent and Alibaba, buying new content on the cheap. They also partner with American companies like Netflix, Sony and Time Warner. We just saw Better Call Saul. Other popular series like Mindhunter, Black Mirror, and Stranger Things are also moved over. They're also moving some of their content to Netflix, which should see more revenue. They have two main competitors in the online video market. They are the most popular service right now. Tencent Video, owned by Tencent, Youku Tudou, owned by Alibaba. Youku is similar to YouTube while Tencent is the main competitor, with similar number of subscribers and users. These are big players, so there is some risk here. There's also trade war tension with China. If that escalates, Chinese stocks will be affected on top of its already volatile price. Looking at their chart, this is a company that moves up and down 5% a day. It's currently on a 28% dip from its highest price. This is a long-term play if you think it'll grow higher, similar to how Netflix grew. Here's Netflix. As you can see, there was a 1000% growth in 5 years. If you're investing in IQ, understand they're a very high-risk company right now. With low numbers, even judging by revenue, it's expensive but cheaper than Netflix in revenue. This should only be a long-term play, or a short-term gamble, because it can definitely drop 50% fast. If you like what you see, check out their platform and see if they have the same potential as Netflix. To see when I buy this company, check out my stock market group in the description. This is the kind of research I put in on every big stock I invest in. It contains my real stock portfolio with many stocks and over $230,000. Every single buy or sell is updated live and on email to you guys. Recent winners include Best Buy at 7% profit, PayPal over 6%, and 2 new stocks over 3% each. There are also 5 new stocks bought just recently that I think will spike soon. It's 50% off until 300 members, only 10 spots are left, so get in quickly. I want to give all early members this 50% off for life. Subscribe and hit that bell for more deep analysis like this. I make them every day to keep you smart. And leave a like if you have a high IQ. Keep watching to buy the best stocks, the Monk way.